Let's look at Shawcor, the ticker SCL.TO, and the TO stands for Toronto. So it's traded on the Canadian Stock Exchange. And we're going to start off with their market cap. So it's a small company, 132 million shares. 132 million market cap, and the stock price is $1.88. So they have 70 million shares outstanding. So what we're going to do is we're going to estimate the future free cash flow of the company, then discount it back to today's dollars, and divide that number by 70 million to get the estimated stock price and see how it compares to the actual stock price. And if it's a lot higher, maybe we'll buy it. And if it's lower, maybe we won't. So first we need cash flow, and free cash flow is a great indicator of a company's future because it's actual cash. There's no manipulation. If you ever look at net income, that can be manipulated based on how they do accounting. But free cash flow can't. It's actual. So they have a bunch of negatives in here, which doesn't look so great. Because if they have too many negatives, then the future free cash flow will be negative, and the stock price won't have a positive number. So this happens with younger companies and startups. But let's see. It's not too bad, the numbers. As you can see, the revenue is the smoothest number, as it is with most companies, and the net income and cash flow is all over the place. So now we have to find the discount rate, and the discount rate for this company is different than other companies. So first we want to see how much interest they pay on the debt, 22 million, 23 million, and then we'll see how much debt they have. We go to the liabilities section of the balance sheet. No current debt, so it's all long-term debt. So 435 million of long-term debt. And long-term debt is debt that's due beyond 1 year, so it might be due in 5 or 10 years, and we could always check the 10K for that. And they pay 5.27% on the debt, so not the best interest rate, but it seems appropriate for the size of this company. Now let's get the income before tax. So it's a negative. Let's look for a positive year, because the effective tax rate won't be correct if we take a negative year. So 23% effective tax rate, that seems about right. So even though they pay 5.27% on the debt, that debt gets discounted based on the tax rate. So the actual cost of debt is 4.06%. And now we want to find the cost of equity, and we need the beta. And they have a pretty high beta as suspected, 2.66. So that means the stock moves 2.5 times the broad market. So it's a volatile stock, and the cap M is almost 23%. So look at the cost of equity, 23%, the cost of debt, 4%. It's so much more expensive equity. So people say, why not just take on debt? Why sell your stock? Just so much cheaper debt. The problem is that with debt, you have to pay interest on it. And if you have a bad year and you can't afford to pay the interest, then you go into default. Where if you just sell part of your company and you don't have to pay a dividend at all, and you definitely don't have to pay an interest rate. So they definitely take the most risk, the equity holders, but they get the most reward, of course, if the company does really well. So when we combine the equity and the debt with the appropriate weights, which are up here of the equity and debt, their WACC is 8.42%. So we have to discount the cash flows by 8.42%. So it doesn't have too healthy of an estimation because of all these negatives. and it looks like in next year we estimate the free cash flow to be 4 million based off of historical numbers, and then the terminal value of 77 million. So we might not get the best reading for this company. These aren't all 4 million, it's just rounding. So when we present value these numbers, we get a value of the company of 69 million. And when you divide it by the number of shares outstanding, the stock price we estimate at 98 cents. So it's trading at a significant premium, more than double the stock price. So the actual stock price is $1.88, and the intrinsic stock price is 98 cents. And now it was trading at a pretty significant premium for many years. This is the past 5 years, this chart of their stock price, and it's come back to somewhat normal intrinsic value. Well, I was trading almost $40. That's pretty high. So obviously they're not putting up the numbers, so people aren't willing to invest money. So if you do invest money, you're not investing on the past, because in the past they're not really making much money. In some years, not at all. You're investing on the future, on what you expect this company to do in the future. So that's the hard part in analyzing a company. Not only looking at the past, you have to kind of estimate what the company may do in the future, and that's unknown to a lot of people. So you could always take these things with a grain of salt. You should look at other models maybe and do your research. But according to this model, it's not a buy, it's a sell. So thanks for watching.